stock market in particular. Now, investing in the market is a topic for which no one can explain in 5 minutes. It's something you can spend a lifetime studying and still not fully understand. That's what happens when the market is moved around by the decisions of millions of other investors. It's just a very complicated topic. But let me tell you what I think is the single most important part of successful investing.
Psychology of Money, Timeless Lessons on Wealth, Greed, and Happiness by Morgan Housel. Morgan Housel, the author of The Psychology of Money, is an author, investor, finance expert, and venture capitalist. Morgan Housel is a partner at the Collaborative Fund. His book The Psychology of Money has sold over 2 million copies and has been translated into 49 languages. Prior to joining Collaborative Fund, Housel was a columnist for The Motley Fool and The Wall Street Journal. He is a 2-time winner of the Best in Business Award from the Society of American Business Editors and Writers, winner of the New York Times Sydney Award, and a 2-time finalist for the Gerald Loeb Award for Distinguished Business and Financial Journalism. He serves on the board of directors at Markel. Morgan has presented at more than 100 conferences in a dozen countries.
And it's like 4 in the morning for me right now, but I'm really happy to be here. And I love coming to other countries and meeting investors from other countries, because when you meet other investors from different countries, you realize that we are all playing the same game. And we have similar emotions, and we have similar goals. But we've had vastly different experiences as investors. And what I've experienced as an investor in the United States is completely different from what you have experienced as an investor here in India. And because of that, I think there's a lot that we can learn from each other.
What kind of blog post would you write on a day like this? And I want to know, what would you be thinking about Tesla the whole way up here? And the chart, I mean, we've seen these charts before. I just would love your take on the current environment first.
Well, something like Tesla, when you're asking what's happening today or what's happened in the last week, I think the better question is, how did it get here in the first place?
Right.
I had joked with a friend last week that I think I see more Hondas on the road than Teslas, and he said, okay, you're wrong about that.
And it's my pleasure to have Morgan Housel here today, author of The Psychology of Money. And Morgan's book has sold, I think, Morgan, 250,000 copies, I believe you told me. And it's one of the better books that's been out, I think, in the last few years. And I've read, I think in my career, I've read most of them and seen most of them. Morgan is a partner at the Collaborative Fund, and a really interesting guy. And I have to say, for his
The Psychology of Money is a collection of legendary stories of investment through time. The success stories and also the fiascos. But more importantly, the lessons to learn from them. What might lead to that output when it is possible to explain it? For Morgan, greed, ego, circumstances, and other psychological traits are responsible of the outcome. We have to be aware of and be careful about all those elements when dealing with money in our life. Morgan Housel calls The Psychology of Money soft skills. The aim of his book is to use short stories to convince you that soft skills are more important than the technical side of money. He does this in a way that will help everyone make better financial decisions. He thinks that these soft skills are greatly underappreciated. Morgan Housel net worth as of 2022 is estimated to be between $5 to $10 million. He has made his fortune through his career as an author, investor, finance expert, and venture capitalist. Morgan Housel's net worth is a testament to his success as both a writer and investor. His keen insights into the psychology of money have made him a respected voice in the financial world, and his work with startups has helped foster the growth of many new businesses. As Housel continues to grow his wealth and influence, there is no doubt that he will continue to be a major force in the world of finance.
Investing in the market is a topic for which no one can explain in 5 minutes. It's something you can spend a lifetime studying and still not fully understand. That's what happens when the market is moved around by the decisions of millions of other investors. It's just a very complicated topic. But let me tell you what I think is the single most important part of successful investing. There's a scene in the movie Lawrence of Arabia when Lawrence puts out a match with his fingers and doesn't flinch. He just takes a match and puts it out and he's fine, doesn't even flinch. Another man watching it tries to do the same and he yells in pain. He says, "Ow, it hurts." "What's the trick?" he asked Lawrence. Lawrence looks at him and he says, "What's the trick?" The trick is not minding that it hurts. The trick is not minding that it hurts. It's such an important lesson in so many things in life where there are no hacks to get around the pain. You just have to learn how to deal with and put up with and endure the pain. It's such an important lesson, including in investing. Maybe even especially investing. Let me show you. And it's great. You made a ton of money just by holding on and letting your money grow. You didn't really have to do anything. This is like the picture of success. This is as good as it gets over a lifetime for an investor. But everything good in life has a cost. If you want something great, you have to pay the price. That's true if you're buying a new car or a new house. You want a nice car, it costs a lot of money. Everyone knows that. There's a price. And investing is no different. Yes, you can make a lot of money in the stock market over a long period of time. That's true not just in the United States, but in a lot of markets all over the world. The long-term history of investing is pretty promising and pretty astounding. But those returns don't come for free. No one is just handing you those returns because they want to be nice to you. You're not entitled to them. There is a cost to earning those returns. There's a price to pay if you want good returns. And that price isn't paid with cash. It's not paid with money. You pay for it by being forced to put up with volatility and uncertainty. Here's another way to view the same chart that I just showed you. This shows the drawdowns, the times you lost money in the stock market, when the market was down from its previous all-time high. And it's a mess. You're losing money all the time. Now here's what's important. At every drawdown in this second chart here, there were investors all over the world, millions of investors who would open their brokerage account and they would say, "This is wrong. This doesn't feel right. Something feels broken. It's uncomfortable and it hurts. And I don't want to be hurt, so I want out." And they sell at just the wrong times rather than holding on and letting their money grow over time. Most investors expect volatility. They get that. What's easy to overlook is the amount of volatility that can take place within the context of otherwise very good returns.
Psychological Concepts About Investing from the Psychology of Money by Morgan Housel. Luck and risk. Never enough. Confounding compounding. Getting wealthy versus staying wealthy.
Luck and risk.
Luck and risk are siblings. They are both the reality that every outcome in life is guided by forces other than individual effort. NYU professor Scott Galloway has a related idea that is so important to remember when judging success, both your own and others: nothing is as good or as bad as it seems. Gates was 13 years old in 1968 when he met classmate Paul Allen. Allen was also obsessed with the school's computer, and the two hit it off. Lakeside's computer wasn't part of its general curriculum. It was an independent study program. Bill and Paul could toy away with the thing at their leisure, letting their creativity run wild after school, late into the night, on weekends. They quickly became computing experts. During one of their late-night sessions, Alan recalled Gates showing him a Fortune magazine and saying, "What do you think it's like to run a Fortune 500 company?" Alan said he had no idea. "Maybe we'll have our own computer company someday," Gates said. Microsoft is now worth more than $1 trillion. A little quick math. In 1968 there were roughly 303 million high school age people in the world, according to the UN. About 18 million of them lived in the United States. About 270,000 of them lived in Washington state. A little over 100,000 of them lived in the Seattle area. And only about 300 of them attended Lakeside School. Start with 303 million, end with 300. One in a million high school age students attended the high school that had the combination of cash and foresight to buy a computer. Bill Gates happened to be one of them. Gates is not shy about what this meant. If there had been no Lakeside, there would have been no Microsoft, he told the school's graduating class in 2005. Luck and risk are both the reality that every outcome in life is guided by forces other than individual effort. They are so similar that you can't believe in one without equally respecting the other. They both happen because the world is too complex to allow 100% of your actions to dictate 100% of your outcomes. They are driven by the same thing: you are one person in a game with 7 billion other people and infinite moving parts. The accidental impact of actions outside of your control can be more consequential than the ones you consciously take. Bill Gates once said, "Success is a lousy teacher. It seduces smart people into thinking they can't lose. When things are going extremely well, realize it's not as good as you think. You are not invincible. And if you acknowledge that luck brought you success, then you have to believe in luck's cousin, risk, which can turn your story around just as quickly. But the same is true in the other direction. But more important is that as much as we recognize the role of luck in success, the role of risk means we should forgive ourselves and leave room for understanding when judging failures. Nothing is as good or as bad as it seems."
Never enough.
John Bogle, the Vanguard founder who passed away in 2019, once told a story about money that highlights something we don't think about enough. At a party given by a billionaire on Shelter Island, Kurt Vonnegut informs his pal, Joseph Heller, that their host, a hedge fund manager, had made more money in a single day than Heller had earned from his wildly popular novel Catch-22 over its whole history. Heller responds, "Yes, but I have something he will never have: enough." Enough. I was stunned by the simple eloquence of that word, stunned for two reasons: first, because I have been given so much in my own life, and, second, because Joseph Heller couldn't have been more accurate. For a critical element of our society, including many of the wealthiest and most powerful among us, there seems to be no limit today on what enough entails. Rajat Gupta's story. Rajat Gupta was born in Kolkata and orphaned as a teenager. People talk about the privileged few who begin life on third base. Gupta couldn't even see the baseball stadium. What he went on to achieve from those beginnings was simply phenomenal. By his mid-40s, Gupta was CEO of McKinsey, the world's most prestigious consulting firm. He retired in 2007 to take on roles with the United Nations and the World Economic Forum. He partnered on philanthropic work with Bill Gates. He sat on the board of directors of 5 public companies. From the slums of Kolkata, Gupta had quite literally become one of the most successful businessmen alive. With his success came enormous wealth. By 2008, Gupta was reportedly worth $100 million. It's an unfathomable sum of money to most. A 5% annual return on that much money generates almost $600 an hour, 24 hours a day. He could have done anything he wanted in life. And what he wanted, by all accounts, wasn't to be a mere centimillionaire. Rajat Gupta wanted to be a billionaire. And he wanted it badly. Gupta sat on the board of directors of Goldman Sachs, which surrounded him with some of the wealthiest investors in the world. One investor, citing the paydays of private equity tycoons, described Gupta like this: "I think he wants to be in that circle. That's a billionaire circle, right? Goldman is like the hundreds of millions circle, right?" Aight. So Gupta found a lucrative side hustle. In 2008, as Goldman Sachs stared at the wrath of the financial crisis, Warren Buffett planned to invest $5 billion into the bank to help it survive. As a Goldman board member, Gupta learned of this transaction before the public. It was valuable information. Goldman's survival was in doubt, and Buffett's backing would surely send its stock soaring. 16 seconds after learning of the pending deal, Gupta, who was dialed into the Goldman board meeting, hung up the phone and called a hedge fund manager named Rajaratnam. The call wasn't recorded, but Rajaratnam immediately bought 175,000 shares of Goldman Sachs, so you can guess what was discussed. The Buffett-Goldman deal was announced to the public hours later. Goldman stock surged. Rajaratnam made a quick $1 million. That was just one example of an alleged trend. The SEC claims Gupta's insider tips led to $17 million in profits. It was easy money. And, for prosecutors, it was an even easier case. Gupta and Rajaratnam both went to prison for insider trading, their careers and reputations irrevocably ruined. Conclusion of enough. The question we should ask of both Gupta and Madoff is why someone worth hundreds of millions of dollars would be so desperate for more money that they risked everything in pursuit of even more. What Gupta and Madoff did is something different. They already had everything: unimaginable wealth, prestige, power, freedom. And they threw it all away because they wanted more. They had no sense of enough. They are extreme examples. But there are non-criminal versions of this behavior. Lessons to learn from these stories. One, the hardest financial skill is getting the goalpost to stop moving. -2 Social comparison is the problem here. The point is that the ceiling of social comparison is so high that virtually no one will ever hit it. Which means it's a battle that can never be won, or that the only way to win is to not fight. 3 Enough is not too little. Enough is realizing that the opposite, an insatiable appetite for more, will push you to the point of regret. For there are many things never worth risking, no matter the potential gain.
Confounding compounding. Getting wealthy versus staying wealthy. Confounding compounding.
More than 2,000 books are dedicated to how Warren Buffett built his fortune. Many of them are wonderful. But few pay enough attention to the simplest fact: Buffett's fortune isn't due to just being a good investor, but being a good investor since he was literally a child. As I write this, Warren Buffett's net worth is $84.5 billion. Of that, $84.2 billion was accumulated after his 50th birthday. $81.5 billion came after he qualified for Social Security, in his mid-60s. Buffett began serious investing when he was 10 years old. By the time he was 30, he had a net worth of $1 million, or $9.3 million adjusted for inflation. What if he was a more normal person, spending his teens and 20s exploring the world and finding his passion, and by age 30 his net worth was, say, $25,000. And let's say he still went on to earn the extraordinary annual investment returns he's been able to generate, 22% annually, but quit investing and retired at age 60 to play golf and spend time with his grandkids. What would a rough estimate of his net worth be today? Not $84.5 billion. $11.9 million. 99.9% less than his actual net worth. Effectively, all of Warren Buffett's financial success can be tied to the financial base he built in his pubescent years and the longevity he maintained in his geriatric years. His skill is investing, but his secret is time. That's how compounding works. None of the 2,000 books picking apart Buffett's success are titled "This Guy Has Been Investing Consistently for 3/4 of a Century." But we know that's the key to the majority of his success. It's just hard to wrap your head around that math because it's not intuitive. There are books on economic cycles, trading strategies, and sector bets. But the most powerful and important book should be called "Shut Up and Wait." It's just one page with a long-term chart of economic growth. The practical takeaway is that the counterintuitiveness of compounding may be responsible for the majority of disappointing trades, bad strategies, and successful investing attempts. But good investing isn't necessarily about earning the highest returns, because the highest returns tend to be one-off hits that can't be repeated. It's about earning pretty good returns that you can stick with and which can be repeated for the longest period of time. That's when compounding runs wild. The opposite of this, earning huge returns that can't be held onto, leads to some tragic stories.
Getting wealthy versus staying wealthy.
If I had to summarize money success in a single word, it would be survival. Capitalism is hard. But part of the reason this happens is because getting money and keeping money are two different skills. Getting money requires taking risks, being optimistic, and putting yourself out there. But keeping money requires the opposite of taking risk. It requires humility, and fear that what you've made can be taken away from you just as fast. It requires frugality and an acceptance that at least some of what you've made is attributable to luck, so past success can't be relied upon to repeat indefinitely. Michael Moritz, the billionaire head of Sequoia Capital, was asked by Charlie Rose why Sequoia was so successful. Moritz mentioned longevity, noting that some VC firms succeed for 5 or 10 years, but Sequoia has prospered for 4 decades. Rose asked why that was. Moritz, I think we've always been afraid of going out of business. Rose, really? So it's fear? Only the paranoid survive? Moritz, there's a lot of truth to that. We assume that tomorrow won't be like yesterday. We can't afford to rest on our laurels. We can't be complacent. We can't assume that yesterday's success translates into tomorrow's good fortune. Here again, survival. This should be the cornerstone of your strategy, whether it's in investing or your career or a business you own. There are two reasons why a survival mentality is so key with money. One is the obvious: few gains are so great that they're worth wiping yourself out over.
He said in an interview that the venture capital business has become more attractive recently, and I'm wondering what you mean by that.
I first started getting interested in the venture business around 1980-81, joined Sequoia a little bit later than that. And if you go back 30 years and think about where technology had gone in the economy, which sort of niches and crevices of the economy it had percolated through, it was far more limited than it is today. And so as technology has gone fracking around the whole US economy, people in the venture industry have just been able to follow it. So there are all these places that people like us didn't invest because technology didn't play a big part in it. And we only have to look around the room here to think about circa the 1980s and people in Silicon Valley investing in advertising companies and media companies and entertainment companies. Those were all considered beyond the pale. And today, obviously, it's an extremely important part of our business. Or think about the hospitality and the travel business, or the...
We can spend years trying to figure out how Buffett achieved his investment returns, how he found the best companies, the cheapest stocks, the best managers. That's hard. Less hard but equally important is pointing out what he didn't do. He didn't get carried away with debt. He didn't panic and sell during the 14 recessions he's lived through. He didn't sully his business reputation. He didn't attach himself to one strategy, one worldview, or one passing trend. He didn't rely on others' money. Managing investments through a public company meant investors couldn't withdraw their capital. He didn't burn himself out and quit or retire. He survived. Survival gave him longevity. And longevity, investing consistently from age 10 to at least age 89, is what made compounding work wonders. That single point is what matters most when describing his success.
Came to New York to make an historic announcement that Warren Buffett was giving $31 billion to the Bill and Melinda Gates Foundation. The logical question is why?
It's something I've always planned. My wife Susie and I had planned that whatever I made would go back to society, and originally I thought she would outlive me and that she'd make the big decision on it, the manner. But since her death, I had to rethink the best way to get the money into society and have it used in the most effective way. And
margin of safety. Many bets fail not because they were wrong, but because they were mostly right in a situation that required things to be exactly right. Room for error, often called margin of safety, is one of the most underappreciated forces in finance. It comes in many forms: a frugal budget, flexible thinking, and a loose timeline, anything that lets you live happily with a range of outcomes. It's different from being conservative. Conservative is avoiding a certain level of risk. Margin of safety is raising the odds of success at a given level of risk by increasing your chances of survival. Its magic is that the higher your margin of safety, the smaller your edge needs to be to have a favorable outcome.
tails, you win.
I gotta add this to my Tinder profile. Thank you, my brothers, my sisters. This means so much, more than I can possibly fathom. I want you to know I watch everything. I watch you all, and the work has been mesmerizing, so I thank you. I've been banging away at this thing for 30 years. I think the simple math is some projects work and some don't, and there's no reason to belabor either one. Just get on to the next and keep telling stories. Thank you for this. My love and respect. Enjoy the evening, because tomorrow it's back to work.
Art dealers and index funds. The great art dealers operated like index funds. They bought everything they could. And they bought it in portfolios, not individual pieces they happened to like. Then they sat and waited for a few winners to emerge. That's all that happens. A lot of things in business and investing work this way. Long tails, the farthest ends of a distribution of outcomes, have tremendous influence in finance, where a small number of events can account for the majority of outcomes. That can be hard to deal with, even if you understand the math. It is not intuitive that an investor can be wrong half the time and still make a fortune. It means we underestimate how normal it is for a lot of things to fail, which causes us to overreact when they do. Some tail-driven industries are obvious. Take venture capital. If a VC makes 50 investments, they likely expect half of them to fail, 10 to do pretty well, and 1 or 2 to be bonanzas that drive 100% of the fund's returns. Investment firm Correlation Ventures once crunched the numbers. Out of more than 21,000 venture financings from 2004 to 2014, 65% lost money. 2.5% of investments made 10 to 20 times return. 1% made more than a 20 times return. 0.5%, about 100 companies out of 21,000, earned 50 times or more. That's where the majority of the industry's returns come from. This, you might think, is what makes venture capital so risky. And everyone investing in venture capital knows it's risky. Most startups fail, and the world is only kind enough to allow a few mega successes. If you want safer, predictable, and more stable returns, you invest in large public companies. Or so you might think. Remember, tails drive everything. Three different strategies with 3 different outcomes. Consider what would happen if you saved $1 every month from 1900 to 2019. You could invest that $1 into the US stock market every month, rain or shine. It doesn't matter if economists are screaming about a looming recession or new bear market. You just keep investing. Let's call an investor who does this, Sue. But maybe investing during a recession is too scary. So perhaps you invest your $1 in the stock market when the economy is not in a recession, sell everything when it's in a recession, and save your monthly dollar in cash, and invest everything back into the stock market when the recession ends. We'll call this Investor Jim. Or perhaps it takes a few months for a recession to scare you out, and then it takes a while to regain confidence before you get back in the market. You invest $1 in stocks when there's no recession, sell 6 months after a recession begins, and invest back in 6 months after a recession ends. We'll call you Tom. How much money would these 3 investors end up with over time? Sue ends up with $435,551. Jim has $257,386. Tom $234,476. Sue wins by a mile. There were 1,428 months between 1900 and 2019. Just over 300 of them were during a recession. So by keeping her cool during just the 22% of the time the economy was in or near a recession, Sue ends up with almost 3/4 more money than Jim or Tom. To give a more recent example, how you behaved as an investor during a few months in late 2008 and early 2009 will likely have more impact on your lifetime returns than everything you did from 2000 to 2008. There is the old pilot quip that their jobs are hours and hours of boredom punctuated by moments of sheer terror. It's the same in investing. Your success as an investor will be determined by how you respond to punctuated moments of terror, not the years spent on cruise control. A good definition of an investing genius is the man or woman who can do the average thing when all those around them are going crazy. Tails drive everything. Freedom. The highest form of wealth is the ability to wake up every morning and say, I can do whatever I want today. People want to become wealthier to make them happier. Happiness is a complicated subject because everyone's different. But if there's a common denominator in happiness, a universal fuel of joy, it's that people want to control their lives. The ability to do what you want, when you want, with who you want, for as long as you want, is priceless. It is the highest dividend money pays. Angus Campbell was a psychologist at the University of Michigan. Born in 1910, his research took place during an age when psychology was overwhelmingly focused on disorders that brought people down, things like depression, anxiety, schizophrenia. Campbell wanted to know what made people happy. His 1981 book, The Sense of Well-Being in America, starts by pointing out that people are generally happier than many psychologists assumed. But some were clearly doing better than others. And you couldn't necessarily group them by income, or geography, or education, because so many in each of those categories end up chronically unhappy. The most powerful common denominator of happiness was simple. Campbell summed it up. Having a strong sense of controlling one's life is a more dependable predictor of positive feelings of well-being than any of the objective conditions of life we have considered. Control over doing what you want, when you want to, with the people you want to, is the broadest lifestyle variable that makes people happy. Money's greatest intrinsic value, and this can't be overstated, is its ability to give you control over your time. To obtain, bit by bit, a level of independence and autonomy that comes from unspent assets that give you greater control over what you can do and when you can do it. A small amount of wealth means the ability to take a few days off work when you're sick without breaking the bank. Gaining that ability is huge if you don't have it. A bit more means waiting for a good job to come around after you get laid off, rather than having to take the first one you find. That can be life-changing. 6 months emergency expenses means not being terrified of your boss, because you know you won't be ruined if you have to take some time off to find a new job. More still means the ability to take a job with lower pay but flexible hours. Maybe one with a shorter commute. Or being able to deal with a medical emergency without the added burden of worrying about how you'll pay for it. Then there's retiring when you want to, instead of when you need to. Using your money to buy time and options has a lifestyle benefit few luxury goods can compete with. Throughout college I wanted to be an investment banker. There was only one reason why: they made a lot of money. That was the only drive, and one I was 100% positive would make me happier once I got it. I scored a summer internship at an investment bank in Los Angeles in my junior year, and thought I won the career lottery. This is all I ever wanted. On my first day I realized why investment bankers make a lot of money: they work longer and more controlled hours than I knew humans could handle. Actually, most can't handle it. Going home before midnight was considered a luxury, and there was a saying in the office: if you don't come to work on Saturday, don't bother coming back on Sunday. The job was intellectually stimulating, paid well, and made me feel important. But every waking second of my time became a slave to my boss's demands, which was enough to turn it into one of the most miserable experiences of my life. It was a 4-month internship. I lasted a month. The hardest thing about this was that I loved the work. And I wanted to work hard. But doing something you love on a schedule you can't control can feel the same as doing something you hate. In his book 30 Lessons for Living, gerontologist Carl Pillemmer interviewed 1,000 elderly Americans looking for the most important lessons they learned from decades of life experience. He wrote, "No one, not a single person out of 1,000 said that to be happy you should try to work as hard as you can to make money to buy the things you want. No one, not a single person said it's important to be at least as wealthy as the people around you, and if you have more than they do it's real success. No one, not a single person said you should choose your work based on your desired future earning power. What they did value were things like quality friendships, being part of something bigger than themselves, and spending quality, unstructured time with their children. Your kids don't want your money, or what your money buys, anywhere near as much as they want you. Specifically, they want you with them," Pillemmer writes. Take it from those who have lived through everything: controlling your time is the highest dividend money pays. And in the car paradox. The best part of being a valet is getting to drive some of the coolest cars to ever touch pavement. Guests came in driving Ferraris, Lamborghinis, Rolls-Royces, the whole aristocratic fleet. It was my dream to have one of these cars of my own, because, I thought, they sent such a strong signal to others that you made it. You're smart. You're rich. You have taste. You're important. Look at me. The irony is that I rarely, if ever, looked at them, the drivers. When you see someone driving a nice car, you rarely think, wow, the guy driving that car is cool. Instead, you think, wow, if I had that car, people would think I'm cool. Subconscious or not, this is how people think. There is a paradox here: people tend to want wealth to signal to others that they should be liked and admired. But in reality those other people often bypass admiring you, not because they don't think wealth is admirable, but because they use your wealth as a benchmark for their own desire to be liked and admired. My point here is not to abandon the pursuit of wealth, or even fancy cars. I like both. It's a subtle recognition that people generally aspire to be respected and admired by others, and using money to buy fancy things may bring less of it than you imagine. If respect and admiration are your goal, be careful how you seek it. Humility, kindness, and empathy will bring you more respect than horsepower ever will. Wealth is what you don't see. Money has many ironies. Here's an important one: wealth is what you don't see. My time as a valet was in the mid-2000s in Los Angeles, when material appearance took precedence over everything but oxygen. If you see a Ferrari driving around, you might intuitively assume the owner of the car is rich even if you're not paying much attention to them. But as I got to know some of these people, I realized that wasn't always the case. Many were mediocre successes who spent a huge percentage of their paycheck on a car. Someone driving a $100,000 car might be wealthy, but the only data point you have about their wealth is that they have $100,000 less than they did before they bought the car, or $100,000 more in debt. That's all you know about them. We tend to judge wealth by what we see, because that's the information we have in front of us. We can't see people's bank accounts or brokerage statements, so we rely on outward appearances to gauge financial success. Cars, homes, Instagram photos. Modern capitalism makes helping people fake it until they make it a cherished industry. But the truth is that wealth is what you don't see. Wealth is the nice cars not purchased, the diamonds not bought, the watches not worn, the clothes foregone, and the first-class upgrade declined. Wealth is financial assets that haven't yet been converted into the stuff you see. That's not how we think about wealth, because you can't contextualize what you can't see. Singer Rihanna nearly went bankrupt after overspending and sued her financial advisor. The advisor responded, "Was it really necessary to tell her that if you spend money on things, you will end up with the things and not the money?" Investor Bill Mann once wrote, "There is no faster way to feel rich than to spend lots of money on really nice things. But the way to be rich is to spend money you have, and to not spend money you don't have. It's really that simple." It is excellent advice, but it may not go far enough. The only way to be wealthy is to not spend the money that you do have. It's not just the only way to accumulate wealth, it's the very definition of wealth. Wealth is hidden. It's income not spent. Wealth is an option not yet taken to buy something later. Its value lies in offering you options, flexibility, and growth to one day purchase more stuff than you could right now. We don't see the savings, retirement accounts, or investment portfolios. We see the homes they bought, not the homes they could have bought had they stretched themselves thin. The danger here is that I think most people, deep down, want to be wealthy. They want freedom and flexibility, which is what financial assets not yet spent can give you. But it is so ingrained in us that to have money is to spend money that we don't get to see the restraint it takes to actually be wealthy. And since we can't see it, it's hard to learn about it. People are good at learning by imitation. But the hidden nature of wealth makes it hard to imitate others and learn from their ways. The world is filled with people who look modest but are actually wealthy, and people who look rich who live at the razor's edge of insolvency. Keep this in mind when quickly judging others' success and setting your own goals. Save money. The first idea, simple, but easy to overlook, is that building wealth has little to do with your income or investment returns, and lots to do with your savings rate. Investment returns can make you rich. But whether an investing strategy will work, and how long it will work for, and whether markets will cooperate, is always in doubt. Results are shrouded in uncertainty. Personal savings and frugality, finances, conservation and efficiency are parts of the money equation that are more in your control and have a 100% chance of being as effective in the future as they are today. If you view it as powered by your own frugality and efficiency, the destiny is clearer. Wealth is just the accumulated leftovers after you spend what you take in. And since you can build wealth without a high income, but have no chance of building wealth without a high savings rate, it's clear which one matters more. More importantly, the value of wealth is relative to what you need. Say you and I have the same net worth. And say you're a better investor than me. I can earn 8% annual returns and you can earn 12% annual returns. But I'm more efficient with my money. Let's say I need half as much money to be happy while your lifestyle compounds as fast as your assets. I'm better off than you are, despite being a worse investor. I'm getting more benefit from my investments despite lower returns. A high savings rate means having lower expenses than you otherwise could, and having lower expenses means your savings go farther than they would if you spent more. Think of it like this, and one of the most powerful ways to increase your savings isn't to raise your income. It's to raise your humility. When you define savings as the gap between your ego and your income, you realize why many people with decent income save so little. It's a daily struggle against instincts to extend your peacock feathers to their outermost limits and keep up with others doing the same. People with enduring personal finance success, not necessarily those with high incomes, tend to have a propensity to not give a damn what others think about them. So people's ability to save is more in their control than they might think. Savings can be created by spending less. You can spend less if you desire less. And you will desire less if you care less about what others think of you. As I argue often in this book, money relies more on psychology than finance. And you don't need a specific reason to save. Some people save money for a down payment on a house, or a new car, or for retirement. That's great, of course. But saving does not require a goal of purchasing something specific. You can save just for saving's sake. And indeed you should. Everyone should. Another benefit of savings that isn't attached to a spending goal is what we discussed, is gaining control over your time. Everyone knows the tangible stuff money buys. The intangible stuff is harder to wrap your head around, so it tends to go unnoticed. But the intangible benefits of money can be far more valuable and capable of increasing your happiness than the tangible things that are obvious targets of our savings. That flexibility and control over your time is an unseen return on wealth. When you don't have control over your time, you're forced to accept whatever bad luck is thrown your way. But if you have flexibility, you have the time to wait for no-brainer opportunities to fall in your lap. This is a hidden return on your savings. Morgan Housel's investing strategy. Morgan Housel's net worth is estimated between $5 and $10 million, and this is his investing strategy. For each family, a different strategy. The difference between what someone suggests you do and what they do for themselves isn't always a bad thing. It just underscores that when dealing with complicated and emotional issues that affect you and your family, there is no one right answer. There is no universal truth. There's only what works for you and your family, checking the boxes you want checked in a way that leaves you comfortable and sleeping well at night. You have to find what works for you. Here's what works for me. Define your goal, your why. Charlie Munger once said, "I did not intend to get rich. I just wanted to get independent." Independence has always been my personal financial goal. Chasing the highest returns or leveraging my assets to live the most luxurious life has little interest to me. Both look like games people do to impress their friends, and both have hidden risks. I mostly just want to wake up every day knowing my family and I can do whatever we want to do on our own terms. Every financial decision we make revolves around that goal. Savings. Independence, at any income level, is driven by your savings rate. And past a certain level of income, your savings rate is driven by your ability to keep your lifestyle expectations from running away. A secondary benefit of maintaining a lifestyle below what you can afford is avoiding the psychological treadmill of keeping up with the Joneses. Comfortably living below what you can afford, without much desire for more, removes a tremendous amount of social pressure that many people in the modern first world subject themselves to. Nassim Taleb explained, "True success is exiting some rat race to modulate one's activities for peace of mind." I like that. Own your house. The independent feeling I get from owning our house outright far exceeds the known financial gain I'd get from leveraging our assets with a cheap mortgage. Eliminating the monthly payment feels better than maximizing the long-term value of our assets. It makes me feel independent. Cash is king. We also keep a higher percentage of our assets in cash than most financial advisors would recommend, something around 20% of our assets outside the value of our house. This is also close to indefensible on paper, and I'm not recommending it to others. It's just what works for us. We do it because cash is the oxygen of independence, and more importantly, we never want to be forced to sell the stocks we own. We want the probability of facing a huge expense and needing to liquidate stocks to cover it to be as close to zero as possible. Perhaps we just have a lower risk tolerance than others. Not being forced to sell stocks to cover an expense also means we're increasing the odds of letting the stocks we own compound for the longest period of time. Charlie Munger put it well, the first rule of compounding is to never interrupt it unnecessarily. Some index funds, retirement accounts, and college saving plans. When I think of it that way, the choice to buy the index and hold on is a no-brainer for us. We invest money from every paycheck into these index funds, a combination of US and international stocks. There's no set goal, it's just whatever is left over after we spend. We max out retirement accounts in the same funds, and contribute to our kids' 529 college savings plans. And that's about it. Effectively all of our net worth is a house, a checking account, and some Vanguard index funds. Tailwinds. It doesn't need to be more complicated than that for us. I like it simple. One of my deeply held investing beliefs is that there is little correlation between investment effort and investment results. The reason is because the world is driven by tails. A few variables account for the majority of returns. No matter how hard you try at investing, you won't do well if you miss the 2 or 3 things that move the needle in your strategy. The reverse is true. Simple investment strategies can work great as long as they capture the few things that are important to that strategy's success. Soft skills. My investing strategy doesn't rely on picking the right sector, or timing the next recession. It relies on a high savings rate, patience, and optimism that the global economy will create value over the next several decades. I spend virtually all of my investing effort thinking about those 3 things, especially the first 2, which I can control. Conclusion. If I had to summarize my views on investing, it's this: every investor should pick a strategy that has the highest odds of successfully meeting their goals. And I think for most investors, dollar cost averaging into a low-cost index fund will provide the highest odds of long-term success. That doesn't mean index investing will always work. It doesn't mean it's for everyone. And it doesn't mean active stock picking is doomed to fail. In general, this industry has become too entrenched on one side or the other, particularly those vehemently against active investing. No one should be surprised that the majority of those trying to beat the market fail to do so. The statistics show 85% of large-cap active managers didn't beat the S&P 500 over the decade ending 2019. I know people who think it's insane to try to beat the market but encourage their kids to reach for the stars and try to become professional athletes. To each their own. Life is about playing the odds, and we all think about odds a little differently.